Hi, everyone. I'm Rick Bensignor. Today is Tuesday, January 5th, 2021. It's a new year, and welcome to this week's In the Know Trader Show. On tap for this week, as we go through our half hour together, in our trader education portion, we're going to talk about the value in reading annual forecasts. We'll take a look at a bunch of different markets, including the NASDAQ 100 tracking ETF, the QQQ, the US dollar index, which has continuously made new lows into year end, copper futures, and then platinum futures. And then this week in our sector analysis, let's start the year off taking a look at what I call Mafang, those 6 key names that are the biggest names out there that seem to push the market, and whether or not these growth names are still the place to be. So we'll look at Microsoft, Apple, Facebook, Amazon, Netflix, and Google. As usual, the best place to get me by email is rick@inthenowtrader.com. And of course, on our website, you can sign up for our weekly report. The Wednesday night ETF Tactical Trader Report is one that reviews macro parts of the market. We usually look at bonds, certainly a deep dive into the S&P, the dollar, metals, etc. And then, of course, a new ETF trading idea every week. And the 7-Eleven report we've been doing since August 1st. It comes out monthly on the 1st of the month or the last trading day of the prior month. And its aim is to beat the S&P, and it's doing that handily so far. In the 5 months, we're outperforming by 210 basis points, which is actually a significant amount to outperform. And if we're doing that in 5 months and we keep on pace for that, we're going to outperform by over 4% on an annual basis. And again, that is everybody's goal on the street who runs Managed Money, and something that's well worth taking a look into. All right, let's get back to here and talk for a few minutes about the value of reading annual forecasts. Every major sell-side firm has their strategists come out with their upcoming annual forecasts. They usually come out anywhere from mid-December into the first week of the new year. And the question that I pose to you is there value in reading these forecasts? Can anybody consistently actually figure out what's going to happen a year in advance? So how accurate are these people on December of a prior year guessing where the next December 31st close is going to be in the S&P? And of course, any of their prognostications has to include a real sense of normalcy, that crazy things don't happen in the market, because they're going to pick wherever the market is going to close for that year, give or take close, and add or subtract a certain amount of typical rational sense of where let's use the S&P as the example, where the S&P would be a year forward. And some people might add 10% or take away 4%, but they're going to be in the general range of what's normal. And if 2020 taught us anything, it's that trying to guess what's normal is not such an easy thing. And yes, there are certainly years that are far less abnormal than 2020 was, but there are very, very few people who can do this with any consistency. So I don't look at, I do read some people's annual forecasts, but I don't do it to get where they think something's going. I do it to collectively, I'll read lots of them to get collectively where the street thinks something's going, especially in the case of looking at things that the street collectively feels is going to happen. And we'll get to that shortly when we talk about the US dollar, because that's one of the big 2021 calls that too much of the street is thinking the same thing. So when we look at the chart, we'll talk about that. So because every major firm comes out with these reports, you should have access, whether you have a relationship with the firm or not. There's enough stuff you can find online to get a general sense of where the consensus trades are and where, again, collectively, even if you go to, let's say, cnbc.com, there is if you do a search, I think you do like analyst forecasts, or S&P annual forecast, there is a page there that will list all the major strategists on the street and tell you what their year-end forecast is. Um, and so you can easily kind of get a collective feeling of what most people think and whether or not there's any um, grouping of people. So in other words, of course you can come up with an average number, but if they're all spread out, it doesn't do a lot of good. I like to see when maybe 60 or 70% of them are all kind of very close to each other, because then you would say that that's consensus. And to me, so often consensus is wrong. And it's why I've been a counter trend player for the bulk of my career is, I try to time, and it's a more difficult task than most people are willing to undertake, but I try to time when the consensus is wrong. And if you can do that with any consistency, you have the best chance of outperforming and making alpha. Uh, in other words, more money than the benchmark would give you, by being able to essentially time highs and lows, or close enough to them so that you're prepared for a turn before other people are. And obviously, I've been doing that a long, long time. If you follow what I do, I've been on the street over 40 years, and the first 12 were trading in the pits, and then I went to Morgan Stanley in the mid 1990s, and was on the sell side for basically the bulk of the rest of the time. I was on the street before I turned into a consultant about 5 years ago. So I do read these annual forecasts. I think you can get some value in them, but the value is in listening to where some person thinks a particular security is going. I couldn't care less where somebody thinks gold is going to this coming year, or what the dollar is going to do, or where they think the S&P is going to be, because they have no clue. And yeah, I can make that as a blanket statement. They have no clue, because you have no idea what's coming next. Again, the world was a crazy place this past year. And if anybody thought they could have predicted that the market was going to sell off like it did, then turn around to explode to new highs, even if you got bullish, and look, we got bullish on the March 23rd low. I put out two major buy signals last year. On March 23rd, the day the market made the low for the year, and April 1st, just a week later, when it pulled back from that rally from the March 23rd low. Those 2 days are the two major buy signals I put out last year. So we caught the lows beautifully. But I'm the first to admit, I had no sense at all, no reason to believe that the market would make new all-time highs. And so we never captured as much of it as we certainly could have, simply because, at certain points along the way, we started reducing long exposure. That, what happened last year is not something you could have predicted at the beginning of the year. Now, as news events occurred, and even the news would have kept you from being fully invested, the right analysis was to understand and realize just how powerful the Fed putting money into the system and their continual willingness to do that as needed, that was going to be more important to investors and the results of the stock market than all the COVID news combined, which is just amazing. And certainly I didn't read it well enough to get that, to understand just how important that, that Fed continual injection of money was going to be. So nobody in December of 2019 could have anticipated what 2020 was going to look like. Now, it's possible some person had a target up, let's just say in round numbers near 3,700. But that certainly wasn't taking the trip of getting clocked like it did in March and then coming back the way it did. That was just a lucky guess. And they certainly likely just added a percentage return from what the prior year's close had been, and it would have been, something that wouldn't have been so crazy at the time. So when I think about these annual forecasts, the best thing I could tell you is, sure, read some of them, get a sense of what people are thinking, but pay far less attention to any specific security or theme they have, and look more collectively at, are these themes consistent with other strategists on the street? And the more you find consensus that something's likely to occur, the more it's not likely to occur. And that's where, I step in and play the game I do as a counter trend player, trying to find those times that when too many people think something's going to happen, the likelihood of it happening is greatly reduced. So that's my thoughts on the value of reading annual forecasts. Let's take a look, before we get to the market overview, let's just take a look at how 2020 ended up as far as the 11 macro sectors. So the S&P was up 16.26% on the year. And here we have the 11 macro, not ETFs, just the macro sectors themselves. Infotech, of what most people just call tech, was up 42% last year, followed by consumer discretionary up 32%, and so on. So tech was up more than 2.5 times what the S&P was. Consumer discretionary was up just about double. Communication services was up probably, I don't know, what's that, 40% higher or so. Then you have the ones that are closer to the S&P's return, materials and healthcare, somewhat close. And then you get the ones that, and of course, anything underneath the materials is an underperformer, but they still had positive returns on the year. Then you get to the ones that, even when the S&P was up 16%, these sectors lost regardless. So utilities, financials, real estate, and energy were the 4 losers on the year. And the ones that, for the most part, were certainly the ones that you'd want to avoid. And this goes back to the 7-11 report that we write monthly and started last August. So as I said, we're up just over 200 basis points in outperformance in the 5 months since August 1st that we started doing this. It's 210 basis points that we're outperforming in 5 months. So on an annual basis, if you were to project that forward, we'd outperform by over 4% if we stay on track. And that is just huge on Wall Street if you can outperform the S&P and do it consistently. And that's the goal of the 7-11 report. I can tell you that since the very first issue in August, we have not been long consumer staples. So we max out at 7 of the 11 that we're willing to hold. We have never held staples. We have never held utilities. We have never held real estate. We have never held energy. And in December 1st, we went long financials. Now, energy obviously had a massive move in November. So, and did actually, it underperformed the S&P in December, but it had a massive move. So this was down at one point over, I think it was 52% at its maximum bad level of the year. But the reason each week we go through and we take a look at the sector versus, you remember, most weeks we look at sector performance week over week. And we do that because we're trying to get the collective feel of what's moving and what's not in comparison to how the market's moving, because this is really the game that most people on Wall Street play. It's to be in the right sectors at the right time. And that is the way to outperform. So if you're listening to this show, then I assume you care enough about your performance that you're not willing to simply accept the S&P's return each year. If it was, you'd buy SPDR ETFs and you wouldn't look at anything else and you wouldn't care about anything else, and you wouldn't be looking at StockCharts.com to get your charts and to listen to shows like this. You'd just be invested in ETFs and you'd say, fine, whatever the market returns, I'll take. The fact that you're listening to this, the fact that you spend time doing your chart analysis, says to me that you care more about the markets and that the average return is not good enough. You want to have above average returns. And that's what the 7-Eleven report is aimed to do. So again, we're only into it 5 months on that side of the equation where we formally have played this versus the S&P. I can tell you on the institutional side, where I have a significant business also, and I consult to many institutions on Wall Street, it's 4 years in a row that I've beaten the S&P. And I've beaten the S&P on average by 3.8 times the return that the S&P has given over the same 4 years. So in other words, the S&P's average annual return in the last 4 years is 15%. And our average annual return is up over 51%. So we're actually at, I forget the actual number, but I know it's at 3.8 times the S&P's return in my institutional report. So this is a game I clearly know how to play and how to beat the market over time with some phenomenal numbers. And there's not a lot of people on the street who can tell you that. And these numbers are made public to the institutions have every trade we do. It's in a spreadsheet. They have access to it. We track every trade recommendation that we put on as a formal trade. If I say I'm bullish gold and gold goes up, I can't tell you that we made money in gold because I didn't tell you where to buy it, where to target, and where to stop yourself out. When I put out an official recommendation where I have those 3 components, a buy or sell signal, a target, and a stop out, those are official recommendations. Those we track in an Excel spreadsheet. And like I said, we last year we beat the S&P again, but we only eked a victory kind of right towards the end of the year. We pulled ahead of the S&P. But collectively, so it's 4 years running, I've beaten the S&P, and we beat it by significant numbers, 3.8 times the return of the S&P. So this game is a winnable game if you know how to play. And that's why I decided, a few years back to create In the Know Trader so that I could give my subscribers, you guys, the ability to have access to the same models that institutions have in order to play the markets and beat the markets. Anybody can play the market. The whole goal is to beat the market. And that's what we do on a consistent basis. All right, let's go to our charts. Let's start off with QQQ. So here's a weekly QQQ chart with DeMarc's. This is TD Combo. It's a sister model to sequential. I kind of like how it caught the highs in here. This 13 signal says upside exhaustion to trend, and then we fall apart. Didn't know COVID was coming. The model simply said upside exhaustion in the first week in February. Said the same thing in April of 2019, and then we sell off for 5 weeks. Here it said exhaustion, and we went sideways for 3 or 4 months. Now, we've got a signal here. We have pushed through it. It's not stopped out yet. That doesn't happen until you get above 335. We also have a setup 9 count. We know 9s often are shorter term indicators. The fact that the 9s and 13s are near each other says to me there's no surprise that we're at least starting to see the year start the way it is. There is some exhaustion type of signals here, which to me says you don't need to be 100% invested. There's nothing wrong with taking some profits. And again, if you're listening to the show, you're probably not a long-term investor. You're more of a trader, and it doesn't have to be a short-term trader, but you're somebody who's looking at markets and opportunities. Speaking of which, here's the US dollar index. And we've been bearish to the dollar for months, and we're getting very close to the first target, which is this zone right in here, which encompasses this 89.23 level, which was the TDST line, the beginning of the trend higher that started in 2018. And sure enough, this is showing up as we're on an aggressive sequential 13 and a setup 9, which means to me we're getting very close to a near-term bottom. It doesn't mean we can't scoot down a little bit more. My minimum downside target for the whole year is 87.50-ish, give or take. But here's my concern. And this goes back to reading analysts and strategists reports going into a year, their forecasts. The US dollar index, or better said, let's just say in general, the US dollar, more people on the street think the dollar is going to be bearish in 2021 than any other macro sector call. It is the biggest consensus call on the street that we're going to see a weaker dollar in 2021. The last time the dollar had such a consensus call was after, looking on the left-hand side where my cursor is, after Trump won the election in November of 16, the dollar shot higher and finished the year on its highs. And going into 2017, more strategists on the street were bullish the dollar than any other macro call. The dollar peaked for the year, the first week of the year, and sold off for the balance of the year and closed virtually on the low of the year. So the strategists not only were wrong, they were dead wrong. Their bullishness on the dollar was the exact wrong call. Now the fact that so many are bearish the dollar, and I'm getting downside exhaustion signals, and this is the first signal we're seeing off of the peak from last year, and the peak was made during the coronavirus big sell-off in the stock market. So same time, in March, the dollar peaked. We're getting the first counter trend signal here that it's getting tired on the downside. We're close to these lows that we saw back in 2018. Again, we could take out the lows and run some stops, but I think we're closer to a dollar, at least a decent trading bottom in the dollar coming up shortly. And given that this is the most predominant bearish call on the street in a collective sense, I'm just wondering, I don't think it's going to happen that it's 2017 in reverse, that, the first week of the year, we make the low of the year and the dollar trades higher for the rest of the year. But I'm not in the camp like so many other strategists and economists are that the dollar is completely going to fall apart. So I'll take it as it comes, but in between these two rectangles, I'm not going to get very bearish the dollar. I'm actually probably going to do some buying. And if I'm right about this, then it also affects just how much, let's say, the metals can rally. And they're rallying nicely now. And gold had a big update. I think it's probably fairly flat today. It's up $6. Platinum is surging. We'll get to that in a second. Let's take a look at copper. Here's copper on a monthly chart. We are at the bullish propulsion exhaustion level in copper right here. We're on an 8 count. So also perhaps getting, kind of late in the run before we see a pullback in copper. So I'm not chasing after copper now. I do own FCX, Freeport Mac, the stock, and it's broken out, and I like how it's trading. But the underlying copper commodity itself is closer to a place that I'm not so interested in buying. And you're gonna, if you own a name like Freeport Mac or Vale or any of these copper, kind of associated equities, you're going to want to watch copper and how it plays out. Last one here is a monthly chart of platinum. It's finally broken out of all downtrend lines. There's not a downtrend line that you can still draw that would be valid. Everything's broken out. You see we're at the top of the cloud, and the propulsion exhaustion level is up here at 1140. So we're at 1115 right now. You got to get above 1140 for this to break out, and then next target something like 1400. So copper certainly has the chance to really explode to the upside. It's the only precious metal that hasn't exploded to the upside the way silver and gold and palladium have. But so I'm going to be watching this. I'm long platinum for myself. I have been for a while, for actually over a year, kind of fishing. I think I first got in on this 9 fishing for a bottom, and I've held it through all this, and because I just believe over time that this precious metal also would break out to the upside. All right, let's take a look at that's the macro overview we're going to do. So let's first take a look at a chart of the 5, or better said, the 6 Mafang names put together into one chart. So this is the price of all these names put together collectively as a single indexed security. And I don't care about the price on the side. It means nothing. What I do care about is the direction and how it plays off of the models we have. And you can see that, let's blow this up, because That's really right now all we care about is the recent action. So you can see that there's kind of a triangle here. Right, so we're kind of right here, give or take. Now, again, this is a monthly chart, so a little break during this month doesn't necessarily mean it's going to break down, but this is important. MACD is still headed down. The two lines are spread apart from each other, so it hasn't even done any sign of a turn upward yet. Momentum continues to fall and really can't get ahead of itself. So this is, how this plays out is going to be important. If it breaks out to the upside, we know that the height of the triangle is easily where it can go to next, which is similar to where this propulsion target is. On the downside, you could easily come back and test, the low end of the triangle, and depending upon how long that takes. If it takes into the well into the first quarter, it could be kind of close to where the top of the cloud is. So pay attention to that. The other thing to look at is the same 6 names versus the S&P. So you can see this peaked out. These, the FANG names peaked out in early summer, July, first week of July. This peaked, and it's been in this downward channel since. But now notice we got a counter setup 9. We can see several times 9 near the high, 9 on the bottom, 9 on the high, 9 on the low. This 9 didn't do it, but we're getting a 9 closer to the bottom of the channel and the cloud itself. So same thing. Gonna kind of watch how this plays, because you don't want to write off FANG. A lot of the streets writing off FANG because it stopped going up, and this has trended down, but it did that for a whole period in here too before turning around and going higher. So just some stuff to watch. And now let's just get to, if we hopefully have enough time, we'll scoot through these. Here's Microsoft on these are all going to be weekly charts. So it's in a triangular pattern. It's done nothing for months, just like FANG itself. Peaked in early July, or in this case, I guess it was late August, sorry, on this one, but gone nowhere. Watch the triangular pattern. Here's your 50-week moving average. Looks like the last few times it's hit it, it's kind of been near the low. So if we got down under 200 and start getting there, you'll have cloud support. You'll have 50-week moving average support. Amazon, similar, and we'll probably see a fair amount of this is similar triangular pattern. So you got to see how this resolves itself. Let's do Facebook. Facebook's been sideways, more flat, peaked also towards the end of August, but instead of being a triangular pattern, it's a little bit more just pure sideways. So same thing here. MACD is down, momentum's down. Nothing really screaming to say be a buyer yet. Let's look at Apple. Different story here. The strongest of the ones we've looked at. So this just made a new all-time high, whereas the other ones peaked over the summer. But setup 9, this is a pure 9-13-9 pattern. So it's kind of a continuation. The 13 was perfect a week or two before the big pullback. It's now made new highs. Same type thing. If you're long the name, nothing wrong. If you know how to play options, nothing wrong with selling upside calls. Netflix. Similar to the other one, sideways, not really triangular. And let's finish up with Google as we're running out of time. Google 13 and 9 also. So stalling here. Not much going on, but certainly on the upside, 1914 gives you the hold on one sec. 1914 gives you upside target here. On the downside, look at 1582. Those are the two levels I'd look at. That's it for this week. Hope you enjoyed the show. I'm Rick Bensignor. This has been In the Know Trader.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.